Joining us for the last of our webinar series for the financial year. We're only a couple of days away from the end of the financial year, and it's amazing how quickly the year disappears on us. I think I was only saying to the kids last night that I can't believe we're halfway through the year already. So we will today. I'm going to spend a bit of time just focusing on talking about the small business restructure. It's certainly become one of the most marketed insolvency strategy options available that I've seen probably in the 89 years I've been involved in the insolvency industry. I've never seen anything marketed quite as much. And if you do a Google search on small business restructure, the sponsored ads go on for days. So I'll try and give my version of it, and we'll talk our way through some of those things. So what I would like today, though, is if anyone has any questions or have any comments or scenarios without names, obviously, that they would like to discuss, please feel free to mention it in the chat that you've got something, and then we can you can unmute yourself or I can unmute you, and then we can either have a chat or you can ask the question in the chat and we can talk it through. So as much as humanly possible in this type of environment, I'd love it to be as interactive as we can. Now, before I get stuck into some of the small business restructure stuff, I will just give a little bit of an update on what's happening in the insolvency industry. As most of you would know, certainly things have heated up across the market, and we're seeing businesses in distress in pretty much every industry now. So a lot of the reports that are coming out are saying that it's really been double-digit increases in every industry in insolvency, and we're not expecting that to let up for at least another, probably 12 to 18 months. The pressure is certainly starting to mount. And that probably highlighted the biggest by the business-to-business payment defaults. So they're up year on year, nearly 70%, so 69.4%. And in simple terms, effectively, that just means that people are defaulting on paying between businesses, and they're defaulting at very large rates. So, and we're finding quite regularly now that we've got customers that are coming to us wanting to get support, wanting to get help, and because their debtors are just not paying. And that's creating enormous pressure on their cash flow and putting their businesses under its own pressure by not being able to pay its own bills. And then once that cascades through and starts flowing through day after day, and month after month, we're finding that obviously the default rates are going up and the insolvency rates are going up. So I think insolvency rates are certainly back. We've been talking about the whole pre-pandemic rates. They're probably 20 to 25% up on pre-pandemic rates now. When they look at the 2019 year and the 2018-19 year as a comparison, we're roughly running at 20% above those rates. On average, we're seeing, just looking at the stats here, the creditor voluntary wind-ups are now running on average at about 500 a month. And that's where directors are making the choice to liquidate their businesses themselves. Court-appointed liquidations are running at around 200 a month. And continuing to rise slowly. I think if I look back from this time last year, they were running at about 140s, 150 a month. They're now running at around that 200 a month. And talking about what we are talking about today, small business restructures, they're up to nearly 200 a month as well now. And if we go back 12 months, they were running at about 50 a month. So there's certainly a marked increase in activity around in the insolvency space, and all forms of insolvency are certainly growing and rising. We're seeing an increased movement from receivers as well. So receivers are really growing, and quite often that's marked a little bit by the fact that people are just repossessing certain assets because people aren't paying them, because they can appoint by a controller, or what they call a controller manager, compared to just a pure receiver. But my understanding of the ASIC stats is that they often fall in the same category. So we're seeing an increase in finance companies and secured creditors pointing to ensure that they're protecting their part of the asset. That will often lead to other forms of insolvency for the companies, because once a controller is appointed, life becomes really difficult. So it's across the board that we're seeing some major growth in the insolvency space. And as I mentioned before, it is happening across all sectors. But one of the big highlights, obviously, is hospitality, and they're saying that effectively 1 in 13 hospitality businesses will face failure in the next 12 months. Is some of the commentary that's around. So as you can imagine, that's primarily going to be in the smaller market. But we've actually seen, even in the last week, some of the big wholesale food retailers, putting stuff into Coles, Woolies, Aldi. They're starting to go down now as well. So we're within the hospitality and the food sector, we're certainly seeing an increase. Another one that we highlighted a couple of months ago is mining services, is certainly copping quite a hiding at the moment as well. And interestingly, education. So I know, just from my own life, going back sort of in the mid-2000s, when we went through some fairly tough times, one of the first things that businesses will stop spending on is training. So you'll find a lot of education services will struggle when businesses start getting tight for cash flow. So now I only mention these things because you've all got clients in multiple sectors across the market, and just having an understanding of where some of these pressures are, as we do the end of year planning that you would all be madly involved in at the moment, and moving into the next 6 and 12 months, is just making sure that you're aware of some of these really high risk areas and talking to those clients early and trying to get ahead of the curve if they are starting to see problems. So if we jump into the small business restructures and start talking about what they were, as I mentioned at the outset, I think in all of my time in insolvency, which is not as long as some of the people even here are listening in today, but in my 18 years, I have never seen a form of insolvency marketed so heavily. It's become one of the flavors of the month, or flavors of the decade almost, since it's been around since 2001, 2021. So it's certainly popular. And if you Google small business restructure, as I said, you have pages and pages of sponsored ads on people wanting to help with SBRs. So as a bit of background, talking about what a small business restructure is, one of the important things to note with them is that it is you have to qualify for to be able to put your company into an SBR. The qualification requirements, the one that's heavily talked about, obviously, is the $1 million limit in creditors. Now, that in itself is actually a little bit complex in understanding, because it's unsecured creditors only, but you can have a secured creditor that has a significant portion of their debt which is unsecured. So if I take an example of a machinery, so a secured creditor who's got a $500,000 machine, that machine may only have a value of $200,000 now, but you still have a loan out on it for $400,000. Only $200,000 of that is secured. If you have an overdraft, and even with an all-PAP in place, now this isn't new understanding, but it's about now that you actually need to understand it a little bit more when looking at whether it's the right thing for a client. If you have an overdraft that might be secured against a home, under the company structure, that is actually still considered an unsecured creditor. So when we're determining what the limit is or what a business is, whether it can qualify just purely on the creditors, it's not as simple as just having a look at what the unsecured creditor list or your trade creditors lists are. So it is important to make sure that you're getting it right, because if you appoint and then a practitioner determines that you're over the limit, then it needs to end, and some of that protection can stop sooner than you would otherwise want it to. Other qualification requirements for it is that all your tax obligations need to be up to date. Now, to be clear, that's tax obligations in terms of your reporting requirements need to be up to date. It doesn't need to be paid, which I think in some ways is probably fairly obvious, given that we're dealing with unsecured and the ATO is actually one of the biggest debtors. But all your tax obligations in terms of reporting need to be up to date. And in the process, we're actually finding it to be quite complex, because they're actually wanting, if you, for instance, lodged a small business restructure today, the ATO is going to want the BAS in 2 weeks' time done as part of the process. So normally those things aren't done while you're in the middle of the process, but now it's actually part of the requirement that they are. The other part of it is that all superannuation that is due needs to have been paid. Again, over the years, we found that superannuation, unfortunately, can often be one of those ones that is left behind or not paid on time when businesses get into trouble. So being able to ensure that you've got them all up to date and paid becomes a critical factor in being able to make sure that you can appoint an SBR. Now, some of the other things that are spruiked at the moment is that it's a quicker and easier process. It's certainly a less complex process than a voluntary administration and deed of company arrangement. And the SBR is really a smaller version of a VA and the deed of company arrangement, for those who understand what that process is. So the proposal period, normally it's 20 days. So once you appoint, you've got 20 days to put together a proposal. The practitioner can ask for an extension of 10 days for that. So it can go out to 30 days. And then there's a 15-day voting period that occurs. So you're looking at around sort of 35 to 45 days to run the whole process. The other really important thing to note with this one and why it's being spruiked so much is that the director remains in control of the company throughout the whole process. Now, there are some limits to their power, and I'll talk about those as we go through the morning. But as a general rule, the day-to-day operations, the staffing requirements, the day-to-day decisions of the business remain with the director, and the director continues to run the business in its normal way. Now, if it wants to sell a significant asset of the business, then they need to get permission to sell that asset. If they want to sell the business in its entirety during the period, they need to get permission to do that sort of thing. But day-to-day operations, and they call it the debtor in possession model, and similar to those who follow international insolvency, it's similar to the Chapter 11s in America. And the only difference is, well, there are a lot of differences, but at the really high level, the difference is you don't need to get the court to approve it, as you do in America in the Chapter 11. But the director remains in control and continues to run the business on a day-to-day basis. Now, as I've mentioned before, that can be problematic, because if you've got creditors who are owed money and you're now telling them that they're not allowed to, that they're in a holding pattern and they're going to be offered a cents in the dollar return, some of those creditors may not want to support the director during that 20 to 30-day period. So if you've still got credit accounts that you want to operate with and use, that needs to be pre-prepared and pre-planned to ensure that it can actually move forward the way that you want it to during that period. Now, if you're not a high product business or you don't need to buy a lot of supplies, then that's obviously less of an issue. But if you are in that type of area where you do need to get products in to continue to be able to sell and complete your jobs, then that can be quite problematic. So it's just something to keep in mind. Yeah, we're finding that it is by far when any of our referrers ring up and say, I've got a client, they want to do an SBR. Everyone seems to be that's the option and the choice. And we've even had clients with upwards of 1.5 to nearly 2 million still wanting to do that. Now, that's actually problematic in and of itself, because if you do pay down, if you have the ability to pay down your debt to get it under 1 million to run that process, you actually create a new problem. Because one of the things that the directors need to sign off when they appoint an SBR is that they need to say that there are no voidable transactions and uncommercial transactions that have occurred in the 3 months prior. Now, as a general rule, a director probably doesn't know what that means, and you as advisors and us as advisors need to have a look at that to a certain extent. But if you paid down your debts in a rush to get it under $1 million, you actually almost unqualify yourself anyway. So it's really important to keep in mind that the SBR is not anything more than another tool that is available for directors who are in some sort of financial strife. One of the other really interesting things that's starting to come into play is that we've got a lot more people starting to use. I'll say before that, it is one of the tools available to avoid a director penalty notice. So when, and again, we're still seeing huge amounts of volume on director penalty notices. So if you have a client who receives a director penalty notice, under the options available to them to avoid the director penalty notice becoming a personal liability, is putting the company into liquidation, voluntary administration, and the other is obviously a small business restructure. So it is a tool that can be used. Yeah, the problem with the SBR, or one of the big problems with the SBR, is that if it fails, the company remains in the hands of the director. So it's really important to be aware that if you're using it to try and help deal with the director penalty notice, that although it does technically remit it, what we've found for the couple that have failed, that the ATO are very quick to reissue director penalty notices. So you need to be ready to move to the next step pretty quickly. Now, when you appoint, and again, these are probably general things that if you have been reading up on it, you'll know, but I think it's important just for clarity to make sure that that everyone's clear. What a creditor can't do once you appoint is that an unsecured creditor can't continue any action that they might have on foot, or they can't start any action to chase against you during the period of the restructure. So it gives you that protection, or it gives the director the protection that they need for a short period of time to give them time to actually come up with a plan. The other thing they can't do is that if there are owners of property, whether it be landlords, whether it be rental leases for forklifts in factories or anything like that, no one can do anything during that period. So they can't lock you out. They can't repossess the forklifts. They can't do any of those things during that period at all. A secured creditor can't use their powers under their secured credit documentation to enforce during the small business, during the term of the restructure. And the final one is that personal guarantees can't be enforced during that period. So it's really a very good tool to just slow all your creditors down and to give you some time, or to give the director some time to come up with some plans to allow themselves to move forward. What we have found, however, is that coming up with the offer is actually becoming more complex. The ATO, without a doubt, is still, I would consider them supportive of SBRs, and I think the numbers are running at 72% of all SBRs that are entered are being accepted by creditors. So there's still a very highly supported model that's being used, and I think 72% is a pretty high rate within the insolvency rate, particularly when you consider that most of those are offering between 15 and 23 cents in the dollar is the average offer that's being made. So, you've got a high level of support coming from the ATO and other creditors for them. One of the complexities, which is not a requirement of the practitioner that's running it, but the ATO, being a significant creditor, is requiring it, and that is that there must still be a comparison done between the company in liquidation and the company under the offer. Now, that's something that we've talked about, that I've talked about in the past with voluntary administrations, that when an offer is made, the administrator needs to compare, if the company goes into liquidation and compared it to any DOCA offer, they then make a recommendation as to whether to accept or reject that offer under the deed of company arrangement. Now, the practitioner doesn't make that recommendation formally to all the creditors, but the ATO has requested that the practitioner make that assessment and provide that to the ATO. It's not necessarily available to any other creditor. It's just available to the ATO in making their decisions. So when we're looking at offers, we've got to be very mindful, or using the SBR, we've got to be very mindful of what the liquidation scenario of that business would be. Now, with a lot of small businesses, it's probably not that high. There's not a lot of assets in small businesses with debts that fit into this category that are significant, but it's certainly an analysis that should be done prior to appointing an SBR, because if it's not going to look the right way, you're not going to get the support of the ATO. The other big factor that we're finding that the ATO particularly is very keen on looking at is what the director loan account position is. So if the director has $200,000 or $250,000 owing under their director loan account, now the ATO's requirement's probably a little bit stronger word, but pretty much what we're finding is that the ATO are wanting an offer to at least be that of the loan account. So if the director does have a fairly large loan account sitting on the accounts, then that becomes a significant factor in determining what the offer needs to look like. And there are cases where we've had the ATOs come back via the practitioner, so where they might have offered, call it 150 when the director loan account's 200, and they've said that they're not going to support unless the offer gets to that number. So it's really, really important, again, in the pre-assessment of all of this, that we're looking at what a director's loan account is and what we can do to get that down if need be prior to the appointment of a small business restructurer. Yeah, and probably the final big one that we're finding is causing in trying to actually make sure that these SBRs occur within the timeframes that we need is that the director needs to be able to offer a cash flow of how they're going to make the payments. So they need to offer a cash flow projections into the future of what the business is going to look like under the new model, and then that needs to be presented as well. One of the interesting things that we've seen is that you can obviously have a fairly positive cash flow moving forward. How real or fictitious it ends up being is obviously something that we'll only know in the course of time. If, however, the cash flow projections are too optimistic, you then create a position where, again, we've had the ATO say, well, the cash flow says that you could actually probably pay more. So not only do you need to, and I think most of you listening here today would be aware that very few small businesses really run good cash flow modelling and cash flow reports. So often you're needing to do those up, and they can actually be too optimistic. So making sure, again, that the cash flows match the offer becomes a really critical part of the process. For the people listening from Queensland, one of the other things that I wanted to highlight, and particularly for the Queensland people or people who have business clients in Queensland in the building industry, the QBCC has been is currently a supporter of SBRs, and doesn't mean that you'll automatically lose your license as you will with other insolvency methods. However, what they have started doing is now asking the practitioner what the asset position of the company will be post the restructure, and then determining whether they still meet the asset requirements under the QBCC. So, and for those who are in Queensland, you'll understand that probably more than some of us who don't have to deal with it every day. But under the QBCC licensing, you get to the different tiers of your licensing, and that has a net asset value that needs to be met. So when you're putting together a proposal, you need to have a look at what the other side is going to look like, because although the QBCC is supportive of SBRs, they're also looking that if you don't meet the new requirements, if you don't meet the requirements post your restructure, they're likely to then take your license away because you don't have the right asset position. So there's a lot of components to making sure that we get these things right for your clients, and making sure it is actually the right tool. I certainly, across all of our offices in Australia at the moment, we're finding that we're having the conversation with clients because they believe that the SBR is the right answer right from the start, and it's not always the right answer. In some cases, doing a voluntary administration and deed of company arrangement is actually a better option than actually using the small business restructure, even if the debts are under $1 million. So I think as advisors, when you're talking about the different options that are available, if you're having that conversation, be mindful not to set the expectation at SBR being the answer all the time, because I don't think it's quite the answer that a lot of people think it is every step of the way. The other thing that we're finding is, because it's deemed to be a softer approach to insolvency, we're finding that we're having issues with other industries. I'll give an example. Down here in Victoria, we had a business that we were looking at doing a restructure for. We went to one of the unions. I won't mention which one it is, but we went to one of the unions to say we're looking to do a restructure. We're going to protect all of the staff. We're going to do all of this sort of thing. They would only allow us to do it under a small business restructure. For some reason in their mind, that was the softer approach and that was a nicer approach, and they would support the director if it was an SBR. If we went into voluntary administration and deed of company arrangement and did the exact same thing, they weren't going to support, and they would pull the support from the business after the DOCA, but they wouldn't pull the support under an SBR. Now, the problem was this client had debts in excess of the $1 million. So the SBR wasn't available to our client, but under the union's beliefs, that was the only option. So the unfortunate result of that is that our directors actually had to make the decision to shut down, and we're going to have 45 staff who are going to be out of work, and FEG are going to have a significant payment that they're going to need to make to all of these staff, because the business can't afford to pay everybody out before it shuts down. So we have in the marketplace at the moment a very unfortunate position of people believing that this is a better or different way of doing things. It's a softer approach, so therefore it's not really insolvency. It still marks on the company record as an external administration, and it still has those same impacts and burdens to the business moving forward. So it is something to keep in mind, that there is a lot more to it than just assuming that it's the softer, easier approach. Having said that, as I said, 72% of them are successful, and they are accepting at around 15 to 23 cents in the dollar. So that is giving a lot of small businesses a lot of hope to move forward. And a large percentage of the ones that our firm have been doing have all been on payment plans. So it does give a significant benefit to the business, because it's not like they need to come up with a lump sum. They can extend what they're needing to, how long they need to pay that off over, compared to particularly if they're going to the ATO, where you're only paying, where generally the ATO is asking for everything to be paid within 12 months. You can now do an offer, let's just average it out at 20 cents in the dollar, and pay that off over a longer period of time if you so choose. And that gives the business a very good chance to move forward. So it is a very good tool. We've just got to be aware of the timing of the tool, and whether it is the right tool in the circumstance. So that's largely a lot of what I wanted to run through. So if anyone does have any questions, please feel free to put a comment in the chat box, or put your electronic hand up. While people are looking at that, I will talk about how it ends, because this is actually a really interesting one. Again, within the insolvency framework in Australia, it's the first time we've had this situation. So an SBR can end for a number of reasons. One can be that the director halfway through the process can just decide and put in writing that they want to walk away from it. So it can just end automatically by the director saying so. And it doesn't really need to be a strong reason. It can just be that the director doesn't want to do it anymore. It will also end if the offer fails. So if they put an offer to creditors and it's not voted positively and accepted, then when the SBR fails, the director stays in control of the business. So it is an interesting thing that you have to declare as part of the process of going into an SBR that you're either insolvent or likely to become insolvent. But when the SBR fails because people didn't vote it through, it will automatically, the company stays in the control of the director, and the SBR just retires. So then it'll be important for something else to happen very, very relatively quickly. So please be mindful of that, again, when looking at that as an option. Certainly something for us, if you're advising your clients to come to us to talk it through. We are very aware of that risk and make sure that we work our way through it. It can also fail just by not making an offer in that 20-day period. So if the directors, after buying themselves the relief and the protection, and they start to sit down and think about it, if they turn around and decide that enough is enough and they can't be bothered doing it anymore, then the SBR will just lapse and stay in the hands of the director, and then they can move forward from there. Paul's asked a question as to how is the ATO treating DPNs in the SBR process? Okay, so as I mentioned before, it is one of the forms of remission of a DPN where the ATO, so if DPNs have been issued and they're non-lockdown DPNs, which means that they can be The director can be protected from the personal liability. If you appoint the SBR within the 21-day period, then those DPNs are deemed remitted and not caught by the ATO moving forward, and not caught on the director through that period. If the proposal is accepted, then the offer will continue on, and payments will be made and will be accepted that way. If the offer fails, then they have to reissue director penalty notices for the non-lockdown components, and then they can start again, and they can reissue and then go after it again. If they are already locked down, it doesn't matter what type of insolvency you're dealing with, they're still caught by the director, which means that you might have a payment plan of 20 cents in the dollar, and some of that money will go to the ATO, and some of that will therefore be offset against the total tax debt, which will pick up some of the director penalty notice money, but the rest may still be a liability of the director moving forward. And that's the same in any form of insolvency. So it can be a bit tricky to work out what will be left for the director personally, but it is something that it will reduce the debt, and again forms part of a strategy. So I've had a situation where the client was looking at an SBR. We were looking at making a 30 cents in the dollar offer, but he had a lot of lockdown direct penalty notices. So paying the 30 cents in the dollar was actually going to, we calculated about 7% of that would end up coming off the DPN debt. So then we had to calculate how much more the director had to pay personally under it. And in that case, we could actually work out that there was a better strategy to ensure that the director was protected, more of the money was going to the DPNs than using the SBR process. Tony asks a question: in insolvent position, does ATO take different views about the breakup of the debt, e.g. tax on wages? Is director still liable for jail term under SBR? Tony, I assume you mean by jail term for insolvent trading. I can see your picture there. So if you're nodding your head, then I'll be able to say, see whether that assumption's right. Really good question. So the jail term relates to insolvent trading if there is an option to chase under insolvent trading. Under an SBR, there is no, if the SBR is accepted, there is no insolvent trading claim that can be made by the practitioner. So therefore, there's no civil or other penalty that can be raised at that stage for insolvent trading. So that really only comes into play if the company goes into liquidation. So insolvent trading can be attacked at that point. And to be frank, jail terms for insolvent trading are pretty rare in Australia. I think we've had in the last 20 years, and don't quote me on this if there are lawyers who might know better, I think there's only been one person jailed for insolvent trading. Most of the time it's a civil claim more than it is a criminal claim. The one person who went to jail for it absolutely deserved it. And there are probably a few others that should have deserved it, but they don't get there. In terms of the breakdown or the different views about the breakdown of the debts, I guess the ATO pretty much is focused on whether they're going to accept using their power of the vote. If they're a smaller part of the total debt, then they may not have the power that they need to vote for it, to vote it. But in theory, the whole insolvency component, by coming out through an offer which is accepted, the insolvent trading component disappears at that point. How it would play out in 12 months' time if the company went into liquidation, and then you look at insolvent trading down the track, it's probably something that hasn't been tested yet to a large extent. So how that's going to play out, Tony, I'm not sure. Failure to pay tax on wages is considered theft because it is belonged by an employee. Not sure if that's a statement or a comment, but I think any failure to pay tax according to the ATO is a version of theft or non-payment, but it's not something that I don't think. I'm not aware of any cases where someone's been charged for theft per se for not paying it. I think it's more of a perception issue that the companies. I know the ATO is very strong on their belief that it's anti-competitive. Yes, happened in Darwin. Okay, well, you know something more than I do, Tony, so we might have to get you on one day to talk about the case. But I'm not aware of that case at all, so I'll look it up. But I do know what the ATO is very strong on is those who don't pay their tax commitments are considered to be anti-competitive, and a big part of what the ATO is trying to drive now is to force businesses to either pay their tax or get out of business, so that only businesses that are operating in the Australian marketplace are playing on the same playing field. So there is certainly a competitive focus, or the ATO's focus is on trying to make it a competitive playing ground. And you can imagine if you've got a cafe, two cafes in one street, one's not paying their PAYG to the ATO and they're not paying their GST, they have a significant benefit over the one that's trying to do the right thing. So the ATO is certainly in their corporate role is very, very focused on making sure that people are either paying or getting out of business. Maybe theft crime was through Fair Work Act court action. Could well be, John. I don't know. What I'll say to everyone listening is that I'll get the details from Tony of the case. I'll have a read of it over the next month, and I'll make some comment in the next webinar in regard to it and how that ties in. But as I say, predominantly the ATO is very, very focused on trying to get the competitive nature of businesses on the same playing field. All right, well, certainly I've learned something there today, Tony, so thank you very much. And John, I'll look into it from the Fair Work point of view. Fair Work certainly has a very different playing field. I will say, for those who have been listening over the last couple of months, a couple of months ago, I had Brent Lotting from Robert James Lawyers on, and we were talking specifically around the state revenue and anyone who's restructuring their businesses or using different structures, and the state revenue having the ability to tack on the controlling interest phase, on the controlling interest because they're beneficiaries. We've seen another case of that come up in the last month. So, and that's from a different state that came from WA. So obviously all the state revenue officers have got together and all the other states have got together and trying to find ways to try and get money back out of everyone. I'm glad I was able to answer it, Tony, so thank you. All right, if there are no other questions, we're 45 minutes in, so I'll get Jazz to put up the poll. I do appreciate that everyone's had to listen to me for 45 minutes ramble on. It is, I generally try and have another guest on rather than it just being me, but we thought it might just be as easy to talk through SBRs with just myself this month. Certainly, I will read up on the case from Tony and I'll provide some feedback next month on that. Certainly interesting that they're going down the theft path. I have actually seen probably the biggest thing I've seen at a more criminal level is actually non-lodgement of tax returns and the ATO charging people criminally for non-lodgement of their corporate forms. That's something I have seen a bit of over the term, but not a lot of the other stuff. So if you have any questions, look, I find SBRs are certainly probably one of the most popular things talked about at the moment. As I said, it's probably the highest market insolvency thing I've seen in many years. But please be a little bit buyer beware about it being the only or the best choice all the time, because it's not always working out the way that people want it to, and there are a lot more complexities in making it help. So keep that in mind. But if that's all we've got, thank you very much. I really appreciate you attending. Happy end of financial year for all the accountants. For everyone else, it's just the end of another month. I look forward to seeing you all again next month. Thank you very much.